In this video, we're going to look at more terminology and GAAP. We're going to first look at a transaction. A transaction is a business event that can be measured in terms of money. So, for example, if a company buys a car for $10,000, that is a transaction for the business. This was a business event, and there's a monetary measurement. The $10,000 was exchanged to buy that car. So therefore, it is a transaction that we will record in the books of accounting. In contrast, the business held a grand opening ceremony today and had the mayor come in and cut the ribbon to open the business. That is a business event, but is not a transaction because there was no monetary exchange during that business event. So, in accounting, we only measure and record transactions. Next, an account. An account is a written record of the increases, decreases, and the balances of an item. So, account is a place where we keep all the increases and decreases and the balance of an item relating to transactions. For example, the cash account will only have cash transactions. So if you go to the cash account, every single transaction that's recorded in that account is a cash transaction. If you go to the land account will only contain land transactions. So again, an account is just a written record of the increases, decreases, and the balances of a particular type of item. Next, we're going to look at some GAAP principles and assumptions. Remember, GAAP stood for Generally Accepted Accounting Principles, which is a set of rules we use to prepare financial statements. The first GAAP principle that we're going to talk about is called the historical cost principle. The historical cost principle says that assets are recorded at the price paid. Sometimes the historical cost principle is also called the cost principle. They just don't use the word historical. Let's look at an example. Let's say that the business wants to buy a lawnmower. So you have a lawn mowing business and the business wants to buy a lawnmower. And you go into Home Depot and you find that there is a lawnmower on sale for $500. You decide to buy the lawnmower, but you also have a coupon that you took with you that gave you $50 off. So the lawnmower is on sale for $500. So when you take it to the register, the price rings up as $500, and then you use your coupon to get another $50 off, and you walk out with paying $450 for the lawnmower. Plus, of course, there's taxes, but again, to keep it simple, let's just ignore the tax part. So you pay $450, walk out with the lawnmower. In the books of accounting, this lawnmower, which is an asset, is going to be recorded for $450. That's what the historical cost principle says. When you look at a set of financial statements, any assets that are in those financial statements are recorded at the price paid. It was recorded at the price that was paid by the business to purchase it. So let's say that you're looking at the financial statement of a company and it has land, and the cost of that land, or the dollar amount of that land in the financial statements is $100,000. That is what the company paid to buy that land. It does not mean that is the market value or current value of that land. It's just what they paid to buy it. So once we record the asset in the books of accounting, we do not adjust the value to reflect market value. It is kept at the price recorded. That is the historical cost principle. The next one we're going to take a look at is the time period assumption. For reporting purposes, businesses divide time into artificial time periods, typically months, quarters, and years. We know that time is continuous, so let me draw something here. We know that time is continuous, but for financial reporting purposes, businesses are going to split time into equal periods so that when they report their financial statements, we're going to report financial statements for those equal periods. Most companies will follow the calendar year, but many do not. So for their accounting year, most companies will pick the calendar year, but some companies will pick a time of the year when they're not really busy. For example, Walmart. Walmart is really, really busy during Christmas and end of the year, so their accounting year is ending on January 31st. January is a slow month for them, so they picked January to be their accounting year end. So their year runs from February 1st to January 31st. And then internally, they'll of course prepare financial statements every month, and they'll also report financial statements every quarter because they are a publicly traded company. For this class, we're mostly looking at preparing financial statements for the year, and then later on we may look at financial statements for 1 month. The next one we're going to talk about is the entity assumption. This says that only the company's transactions are recorded in the books of accounting. We know that the company interacts with multiple different companies, but when you're looking at a set of financial statements, only the company's transactions are reported. Also, a company has owners. If it's a large publicly traded company, there are multiple owners. There are millions and millions of owners of a company, but you can have a small company with one owner, and that one owner will run the company, but when you're looking at the financial statements of a company, the owner's transactions are not recorded in the business accounts. They have to be kept separate from the business. So the entity assumption says the company is the entity, and when you look at financial statements, only the company's transactions are recorded in the books of accounting. Sometimes the entity assumption is also called the business entity assumption. Finally, when we are doing accounting, so in this class when you're looking at accounting problems or when we are looking at financial statements, all the transactions we're going to look at are viewed from the company's perspective. I tell my students, when you are doing your homework, always ask the question, who are we? We are the company. We are inside the company looking out. When we look at transaction analysis in the next set of videos, we're always going to say, we're the company. Well, how do these transactions affect us? That is a key to understanding accounting. You have to look at transaction from the company's perspective. That's it for this video. If you have any questions, please let me know.